Low appraisals in a declining market. These are the things that nobody ever tells you about that you'll only discover in a declining market. Stay tuned to find out exactly what I mean. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you joined me here today. Today, I'm going to be talking about a topic that doesn't really matter to most people when the market is going crazy and the gravy train is going choo-choo and keeps on going. But what a lot of people forget about in a slowing market that we're in right now, how this particular thing can have a huge impact on them. And this is the appraisal when you go and get a mortgage. Yes, the appraisal, the very boring things that I have to talk about right now because of the situation. Let me give you a refresher of how this works, right? In case you don't know the nitty gritty. When you go and get a mortgage for the property you just purchased, like you go to the bank, they need to send an appraiser to the property to make sure what you bought is worth it. So this is a guy, third party or gal that goes there and said, hey, you bought this for X, it needs to be worth X, so that the bank is going to actually give you money based on that value. So that third party person is essentially making sure that you didn't get ripped off or that you didn't pay too much for this property, and that's going to lend you the appropriate money that you need to get this, right? Because, with most banks, they're very risk averse and they want to make sure they're not lending you too much money and that they're underwater. And that's part of the underwriting process, right? So if you underappraise the property you bought, you are in some trouble. Let me illustrate this with an example for you. So if you bought a property for $1.1 million, just call this the height of the market, right? And prior to closing, the appraised value that you got is only $1 million because, the market has softened, right? So it's declining because if you're at the peak, it's come down a little bit, prices are down. And your bank is only going to basically lend you based on that $1 million appraised value. So if you're anticipating 80% of your mortgage, right, at $1.1 million, or call it $880,000, yeah, they're not lending you that, and you're in for a hurting. Because the bank appraised your property at $1 million and they're only going to lend you 80% of that $1 million or 80% loan to value, LTV, which is $800,000. Now, this means that you're getting an $800,000 mortgage on this property you bought for 1.1 mil instead of $880,000. Meaning now you have to come up with $300,000 down payment instead of the 20% on the 1.1, which is $220,000. That's about an $80,000 swing in cash you need to come up with. This is even extra problematic if you were stretched thin, ill-advised, and the rates are rising right now, because even if you try to get a private mortgage on the balance of difference, it's going to be very, very costly. And that becomes a big problem for a lot of people. This is why, right now, a lot of people are trying to walk away from the firm deals that they agreed upon because that's the situation they find themselves in. And that's a whole episode on that. And I'm going to bring in my lawyer, which I'll probably drop this Saturday, to talk about all the things that can come along with walking away with your contract, right? So make sure you subscribe and click the little bell icon so you know when I drop that episode. Now, if this is the type of real estate content you enjoy, then please help us spread the knowledge by smashing that like button and subscribing to the Prime Properties channel, because every week we put out awesome content like this so that we can give you an idea of what the hell is going on in the market, and also provide you some tips like this on how to not get in trouble, so that whenever you think of buying, selling, and investing in real estate, you'll be like, Zen and his team, they know what they're talking about, and they're going to book a call with me to kind of strategize your future. And you can do so by using the link right here. It's www.chatwithzen.com. Now, back to what I was saying, in a rising market, appraisals are never really an issue and never talked about. That's why I had to make this video, because the next house that sells is just breaking the record again. So, you're good. But the problem is, in a declining market, the gravy train has essentially stopped. And people who are, swimming naked after being exposed are the ones that have to deal with this. And I've seen a lot of this before. This is why I have to make this video, to kind of give everybody an idea of what's happening. Now, if you're able to close because you have extra cash, or you can just get some help, great. If you can't, then you're in for some trouble. Now, if you find yourself in this situation, unfortunately, there's nothing I can do to help you. The only tip I can give you to kind of get you past this low point is, since you already pulled your credit with the bank and they're giving you the balance of the mortgage on the underappraised value, you should go to every single bank possible and go get unsecured lines of credit to come up with the balance of that money for the appraisal so you can close properly. Because if you don't close properly, there are actual damages and it can actually be more costly. Now, you may be able to close on your contract and not breach if you follow that strategy with the line of credit. And this is exactly why that I've warned a lot of people who called me about investing to kind of stay away from the pre-construction space, because this is exactly where it happens a lot. This is where if you were smart, you would have been super selective with the pre-construction project you bought into. And this is the reason why I preach so much in the last 3 years to be extra cautious when it comes to pre-construction. Because ever since 2018, pre-construction has been trading at an incredibly high premium over the resale, and that any cracks in the market can leave you completely exposed. And while you may have made some money, you would have taken extra risk. And I've seen so many people in the 2017 market when it kind of took a dip and people couldn't close on the property, they were sued for damages, which a lot of people don't understand, because in a frenzy, people just buy. So this is story time, folks. In 2017, the freehold market in York region was ripping hot, and the pre-construction houses were selling like 20 to 30% premium on top of resale market, but the resale market was going up at that pace, right? Now, keep in mind, freehold properties take a lot less time to build than like an apartment style condo. And a ground level home takes somewhere between a year and a half, so 18 months or so to build, whereas a condo takes 5 years. So when the market drops 20+% to 30+% and stayed that way for a while, despite the tiny little bit of appreciation we saw in late 2018, it dropped 20% already. And this is specifically the freehold homes. The pre-construction properties that were bought at 20% of the premium, after it took a 20% nose drop and went up a little bit, those people who bought it were still like 30% underwater on the appraisal. So on $1 million, that's $300,000 in appraisal difference, right? You see what I mean? And that's just absolutely wild. So your appraisal difference was almost 2 times what you paid your deposit for. So people couldn't close, defaulted, and eventually some of them were actually sued by the builders for the difference whenever the builder sold the unit for less. And yes, you heard me correctly. Even if you walk away from your contract and lose your deposit, you can still get sued for damages, which is usually the amount of money that you bought the property for, minus whatever the builder ultimately sold it for. So if you bought it for 3, they sold it for 2, they can sue you for 1, right? And that's where I'm seeing a lot of people get hurt again in the pre-construction freehold space. So when I'm seeing people buy pre-construction freehold homes at premiums like 2-3 months ago, I warn them constantly, be careful what you're doing. But some people don't listen. Anyways, but if you're doing this with the condo space, you're a little bit better, because if your pre-construction condo is bought, say, at a 30% premium from the resale around the area, you're assuming a build time of, say, like 5 years, right? Which means you need about 6% appreciation per year for you to break even and not have an appraisal risk. But what if the market trades sideways for, say, 2 years, like the pandemic for condos, right? We haven't seen that in the condo space for a while because they were still quite affordable, right? So, rates kept going up. So even if you bought in 2017, you're still looking like a genius now. So condos that are closing now were bought in the 400s, which is fine. You're good, right? But what happens in 5 years when these 1 bedrooms that are bought for $700,000-$800,000 are closing? Are we going to be there? Maybe, only time will tell. But that's why, you can be hands off with pre-construction, but I've stayed away from it because I can see the inherent risk, because you're paying that much of a premium to buy that contract. And I just don't think it's worth the risk for the returns. Now, prices don't always go up. And if you've ever experienced a slow market, you'll understand why I have so much caution on this, right? However, the silver lining to all of this is if you bought your pre-construction on par with like the resale around the area and you use a conservative rental increase for your cash flow, I think you're fine, right? There are some projects I've seen in the last few years that were great, but there are a lot of them that are just way out for lunch, right? And that's why there is a method to my madness on being so particular on what to invest in and why there's a theory, because I've seen a lot of shenanigans in the last decade I've been trading real estate. So in the interim, if you think you've overpaid for a pre-construction property, you may want to consider setting some money aside for the closing, whenever that may be, if you did, pay above the premium on the resale, assuming that was your intention to close it, right? Now, if you plan to assign it for a quick buck and you didn't watch my video up here on why you shouldn't assign, brace yourself. You're in for a real treat when the market comes down and you can't close and you're trying to assign. yeah, you just really fingers crossed for that the market doesn't stay this way. Anyways, that's enough doom and gloom for you. I just have to put this out there because a lot of people are wondering what's going on, but I just want to make a video to give you a heads up in case you are caught in a tough position. Again, closing, try using the line of credit. If you are having a pre-construction that buy a little bit on the high side, make sure you have some money on that risk appraisal, on the appraisal, right? Now, if you're looking to invest in property where we cap the downside and we are cash flowing on existing properties, you can book a call with me using the link right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.